Hey everyone, welcome back to the Deep Dive. We're diving into some real investment wisdom today, folks. Ready to unlock the secrets of Benjamin Graham's The Intelligent Investor? We're going to break it all down for you, nice and easy.
Yeah, think of this as your express lane to understanding those core investment principles, cutting through all the noise and hype you hear every day, without getting bogged down in all those confusing details.
Absolutely. So we're talking about Benjamin Graham, right? This isn't just some random guy. This is a big deal in the world of investing, like seriously huge. He's considered one of the most influential thinkers in the history of this whole game.
Yeah, no doubt. His work, especially starting with security analysis and really hitting its stride with The Intelligent Investor, he pretty much revolutionized investing.
He did. He took it from this kind of, almost like an art form where people relied on intuition and guesswork and turned it into a much more rigorous and analytical process.
Yeah, and what's really cool is that Graham's ideas weren't just, some abstract theory. He went through some serious financial struggles himself, right? Especially during the Great Depression. Those experiences, they really shaped his investment philosophy.
They grounded it in like this really practical, common sense approach. He believed that buying stock at its core meant owning a piece of a real business. It's not just about numbers on a screen.
Exactly. And if you're still wondering if this guy is relevant today, in our crazy modern market, just think about this. Warren Buffett himself, the Oracle of Omaha, he wrote the preface to the 4th edition of The Intelligent Investor.
Wow, yeah, that's a pretty strong endorsement right there.
And Buffett, who was deeply influenced by Graham early in his career, he still considers this book to be like the Bible of investing. The gold standard.
It's like getting a personal recommendation from the investing goat, right?
Exactly. And he emphasizes, too, that investment success isn't about, being a genius or having some secret insider information.
It's not about those hot stock tips you see on social media.
No, not at all. He says it all comes down to having a solid intellectual framework and, most importantly, having that emotional discipline. Keeping a cool head when everyone else is losing theirs. He even specifically highlights chapters 8 and 20 as being especially crucial.
Okay, so let's get down to brass tacks here. What are some of the key takeaways right from the intro? What should our listeners really be focusing on?
All right. 3 core lessons really stand out, especially after, all the market craziness we've seen in recent years. Think about the dot-com bubble bursting or the financial crisis of 2008.
Yeah, those were wild times.
Right. So first and foremost, avoid those big, irreversible losses. That's priority number 1.
Don't go betting the farm on something risky.
Exactly. Second, aim for those steady, sustainable gains. Slow and steady wins the race, right? And third, you got to get control of those knee-jerk emotional reactions. Those can absolutely sabotage your investment decisions.
It's so easy to get caught up in the fear and greed of the market.
Oh, yeah. And Graham knew that better than anyone. He understood that a lot of times our biggest enemy in investing is ourselves, our own behavior.
It's not the market. It's us.
Often, yeah. And this brings us to a big question. Who exactly is this intelligent investor that Graham keeps talking about?
Right. Who is this person?
Well, it's not necessarily the person with the highest IQ.
So you don't need a PhD in finance.
Not at all. The intelligent investor, according to Graham, is someone who demonstrates patience, discipline, emotional control, and the ability to think for themselves. They don't just follow the herd.
They do their own research. They don't panic. They don't get swayed by the hype.
Exactly. History is full of examples where, brilliant minds made some really dumb investment decisions. Remember Sir Isaac Newton?
Yeah, the gravity guy.
That's him. A brilliant physicist, right? Lost a fortune in the South Sea bubble.
Ouch, yeah.
And then, much later, the collapse of long-term capital management. This hedge fund was packed with Nobel Prize-winning economists and mathematicians, and they still blew up spectacularly.
So even the smartest people can make mistakes, especially when they let their emotions take over.
Exactly. It just goes to show that even genius-level IQ doesn't guarantee investment success. It's about temperament as much as it is about intellect.
All right, so let's dig into one of the most fundamental concepts that Graham lays out right from the start. The difference between investment and speculation. This is like the foundation of his whole philosophy, wouldn't you say?
Absolutely. It's the cornerstone. And Graham's definition of investment is very specific. He first laid it out in security analysis way back in 1934.
So this idea has been around for a while.
Oh, yeah. An investment operation, according to Graham, is one that, after thorough analysis, promises both safety of principal and an adequate return. Both of those things have to be there.
Safety and return. So you're not losing your money and you're making a decent profit.
Exactly. Anything that doesn't meet both those criteria, anything else, that's speculation. Plain and simple.
And it's amazing how often people throw around the term investor today for all sorts of things that Graham would probably call, straight up gambling.
Yeah, it's used so loosely.
Like someone buying some meme stock based on what they saw on Reddit. Graham would be like, nope, that's not investing. That's speculation, pure and simple.
Yeah, or jumping into a super volatile cryptocurrency without really understanding what it is or how it works.
Just chasing the hype. And Graham would say that blurring those lines between investing and speculating, it's not just a matter of semantics. It can actually be really dangerous.
Absolutely. It can lead people to take on way more risk than they realize, all while thinking they're making these sound, responsible investments, and that can be a recipe for disaster.
Okay, so let's talk about one of Graham's key investor profiles, the defensive investor. Who is this person, and what are they all about?
The defensive investor is someone who prioritizes safety above all else. They want to protect their capital, and they're not looking to spend a ton of time and energy managing their investments.
They want something relatively simple, right?
Exactly. Minimal effort, maximum peace of mind. And for this type of investor, Graham recommends a very specific portfolio, a 50-50 split between high-grade bonds and leading common stocks.
Half in bonds, half in stocks.
Yeah. Generally speaking, he did acknowledge that, you might need to tweak that a bit depending on what's happening in the market. But that core idea, having that balance between those two basic asset classes, that's key.
Now, what kind of returns could a defensive investor realistically expect to see if they follow Graham's approach? I mean, let's be real. Everyone wants to know about the money.
Right, of course. So Graham talked about a historical average of around 7.5% annually from stocks, and that includes both the dividends you receive and the increase in the value of the stock itself.
7.5%, that's not bad, especially if it's relatively safe.
Exactly. And he was very clear that this might be lower than the overall market returns in some really hot periods. But the goal here is different. It's about achieving that consistent, reliable growth over the long term.
It's about playing the long game, not chasing those quick wins.
Exactly. Minimize the risk, maximize the peace of mind. That's the defensive investor's motto. And what's interesting is how Graham thought about how this defensive approach should adapt to different market conditions. He looked back at the period between 1964 and 1971, a time of some pretty significant market ups and downs.
Kind of like what we've seen recently, in a way.
Yeah, in some ways, very similar. And he noticed that sometimes bonds actually became a more attractive investment than stocks, just because of the way yields and returns were fluctuating. But even then, his core advice stayed the same. Maintain that balanced approach.
Don't abandon stocks entirely, even when bonds are looking good.
Exactly. Keep a significant chunk of your portfolio in those high-quality stocks, because in the long run, you want to be participating in that overall economic growth. That's where the real potential is.
Stocks are your ticket to long-term growth, even if they go through some rough patches along the way.
That's right. And for someone who really values simplicity and safety, what are some other strategies that Graham recommended for the defensive investor? What can they do to make this whole process even easier?
Because let's face it, not everyone wants to spend hours poring over financial statements.
Right, exactly. So he had a few suggestions. Investment funds, for example, are a great way to get instant diversification.
So you're not putting all your eggs in one basket.
Exactly. And they're professionally managed, so you don't have to be the expert, you know? It simplifies things a lot.
Outsourcing the work, essentially.
Right. And then there's dollar cost averaging. Have you heard of that?
Yeah, it's basically investing the same amount of money at regular intervals, like every month or every quarter, right?
Exactly. And that helps smooth out those price fluctuations over time. It reduces the risk of buying high because you're buying a little bit at a time, no matter what the market is doing.
So you're kind of taking the emotion out of it. You're not trying to time the market perfectly.
Precisely. And then there's formula investing, which is basically like a set of rules for when to buy and sell stocks, all based on how the market is moving. It's like having a little investment robot working for you in the background.
A set it and forget it approach, basically.
Right. And it takes the emotion out of those decisions because you're just following the rules. You're not letting fear or greed dictate your moves.
Okay, so now let's switch gears and talk about the enterprising investor, sometimes called the aggressive investor. Who is this? And what sets them apart?
This is the investor who wants to do more than just keep pace with the market. They're actively looking to beat the market, to outperform those average returns.
They're looking for those bigger gains. More risk, more reward.
Exactly. But even for those aggressive investors, Graham set a really important primary goal, and it might surprise you. He said the main thing is to avoid underperforming the market.
So it's not about hitting home runs every time. It's about not striking out.
Yeah, it's like that. It's about consistency and about making sure you're not taking on unnecessary risks just for the thrill of it.
So what are some of the strategies that aggressive investors often use, and what was Graham's take on them?
Well, there's trying to time the market, which everyone's heard of, right? Buying when you think prices will go up, selling when you think they'll go down. It's tempting, but...
It's really hard to do consistently. Even the pros struggle with it.
Exactly. And then there's short-term stock selection based on things like quarterly earnings reports.
Trying to jump in and out of stocks based on those short-term fluctuations.
Right. And even making long-term bets on like growth companies or emerging industries, those can be really risky too. Because a lot of times any good news is already baked into the stock price.
By the time everyone's talking about it, it might be too late to make a big profit.
Yeah, that's often the case. And Graham pointed out that the problem with these approaches is that they involve a lot of risk.
And you have to be right more often than you're wrong.
Exactly. And it's really hard to be right consistently when you're trying to predict the future.
So if those more aggressive strategies can be so risky, what did Graham recommend for investors who are still aiming for those above-average returns? How can they do it intelligently?
Well, he stressed the importance of finding and investing in undervalued stocks, companies that the market is overlooking for whatever reason, or that are being unfairly punished because of some temporary bad news.
Finding those hidden gems, basically.
Right. And this requires patience. You got to be willing to do your research, to think differently from the crowd, to be a bit of a contrarian.
Be greedy when others are fearful, and fearful when others are greedy.
Exactly. And he also talked about the possibility of short-selling overvalued stocks. But he was very cautious about that because that's a really risky strategy and it can backfire in a big way if you're not careful.
You can lose a lot more money short selling than you can buying a stock.
Exactly. And he briefly touched on what he called special situations, things like, arbitrage, where you're trying to profit from price differences between different securities, or investing in companies that are going through liquidations or mergers and acquisitions.
Kind of like those more niche opportunities.
Right. And historically, those could be quite profitable. But Graham also noted that as those strategies got more popular, as more people started doing them, the returns tended to go down.
So less of a secret edge over time.
Yeah, the market tends to become more efficient as those opportunities get exploited. So what's the big takeaway here for aggressive investors? What does Graham ultimately say?
What's the bottom line?
He said that yes, aggressive investing is inherently riskier than the defensive approach. But if you're disciplined and you're following sound, less conventional strategies, it is possible to beat the market. Specifically, he said to focus on finding those undervalued securities by doing thorough, logical analysis. Don't just chase the hype.
Do your homework. Don't just rely on what you read on Twitter or whatever.
Exactly. And he even gave a specific target. He said, aim for a return of roughly 5% per year above the market before taxes. And he emphasized that there are tons of opportunities out there in the vast universe of publicly traded stocks. You just got to be willing to put in the work to find them.
Okay, let's talk about something that's always on investors' minds, something that can really eat away at your returns over time. Inflation. Graham dedicates a whole chapter to this in The Intelligent Investor. Why is it so important?
Well, inflation is a huge deal. It erodes the value of your money, plain and simple. It can make those fixed income streams, from things like bonds, a lot less attractive over time. And it eats away at the real value of your invested capital.
It's like a silent thief stealing your purchasing power.
Exactly. And Graham is writing at a time when there was a big debate about how to handle inflation. Some financial experts were saying, ditch bonds completely, go all in on stocks.
A pretty radical idea back then.
Yeah, a huge shift from the traditional wisdom, which was that bonds were safe and stocks were risky.
But Graham, being the advocate of balance and careful analysis that he wasn't buying into that all-or-nothing approach, was he?
Nope, not at all. He said, hold on a second. No single asset class is perfect all the time. Even stocks, which people were touting as the ultimate inflation hedge, can underperform bonds sometimes. It all depends on the circumstances.
It's all about understanding the nuances, the trade-offs.
Exactly. He warned against making broad generalizations, just like he warned against that old-fashioned idea that any bond was automatically safer than any stock. It all depends on the specifics.
It's not that simple.
No, definitely not. And he emphasized how important it is to look back at history, to study past periods of inflation, to really understand how it's impacted markets and investors over time.
Learn from the past, right?
Exactly. He pointed out how dramatically the cost of living went up between 1915 and 1920 compared to the inflation that was happening in the late 1960s.
So inflation can really spike sometimes much more than people might realize.
It can. And that historical context is so important because it helps us have a more realistic view of how inflation might impact us in the future.
Okay, so the million-dollar question, maybe the billion-dollar question these days is, can you predict inflation? What did Graham have to say about that?
Well, he was pretty realistic. He said it's really tough to predict future inflation rates with any kind of certainty. There are just too many variables. But he did suggest a practical approach.
Is this a secret?
Well, not a secret exactly, but he said, look at the average inflation rates over the past few decades, and also look at the more recent trends, where things seem to be heading.
Get a sense of the big picture, historically and recently.
Right. And based on the data he had back then, he projected that a future average inflation rate of around 3% per year was a reasonable guess, but he was very clear that this was just an estimate.
It's not set in stone.
Definitely not. Now, a lot of people say that stocks are a better hedge against inflation than bonds. What did Graham think about that?
Because that's a pretty common argument, especially these days.
Yeah, it is. And Graham acknowledged that historically, yes, stocks have generally outperformed bonds. He looked at the Dow Jones Industrial Average from 1915 to 1970, and yeah, the returns were higher.
So there's some evidence to support that claim.
There is, but he also warned against thinking that this past performance guarantees anything about the future, because markets can be unpredictable and things can change.
The past is not always a reliable predictor of the future.
Especially in the short term. You could have a few bad years, even with stocks.
What about the relationship between inflation and corporate earnings? I mean, you'd think that when prices go up, companies would make more money. But is it that simple?
Well, it would seem that way, right? But Graham said it's not always a direct correlation because there are other factors that come into play.
There are other things going on behind the scenes.
Right. Like when inflation is high, companies often have to deal with higher depreciation expenses. And they might have a lot of debt, and the interest rates on that debt might be rising, so that can eat into their profits.
So even if their revenues are going up because of inflation, their expenses might be going up even faster.
Exactly. So it's not a guaranteed win for companies when inflation rises. And he also talked briefly about other traditional inflation hedges, like real estate and gold.
Those are the classic safe havens, right?
Yeah.
What did he say about them?
Well, he acknowledged that they can be effective to a degree, but they also have their downsides.
They're not foolproof.
Definitely not. Real estate, for example, it's a tangible asset. You can touch it, you can live in it. And historically, it tends to hold its value pretty well during inflationary times. But it's not very liquid.
It's not easy to sell quickly if you need cash.
Exactly. And it's very dependent on local market conditions. Real estate in one city might be great, while real estate in another city tanks. So it's not a guaranteed win. And gold, well, it's been seen as a safe haven for centuries. When things get really bad, people flock to gold.
It's that classic fear trade.
Right. But even gold can be volatile. Its price can fluctuate a lot, so it's not always the perfect hedge.
So what's the bottom line when it comes to dealing with inflation as an investor? What did Graham ultimately recommend?
He said, don't put all your eggs in one basket.
Don't go all in on stocks or all in on bonds.
Exactly. He recommended a balanced approach. Hold a mix of stocks and bonds, diversify your portfolio, and that's the best way to protect yourself against the uncertainties of inflation and the market in general.
Don't try to time the market. Just stay diversified.
Exactly. And even those conservative investors, he said, those folks who really prioritize safety, they still need some exposure to stocks to help them keep pace with inflation over the long term.
Because even if you're risk averse, you still got to protect your purchasing power.
That's right. Okay, let's move on to Chapter 5, which focuses on the defensive investor and common stocks. It's kind of fascinating that back in 1949, when the first edition of this book came out, Graham felt like he had to make a case for including stocks in a conservative portfolio at all.
Yeah, stocks had a really bad reputation back then, right?
They did. After the Great Depression and all that market volatility, a lot of people saw stocks as being inherently speculative and way too risky for anyone who is trying to be careful with their money.
They were seen as a gambler's game, not a serious investment.
Exactly. So Graham had to lay out his arguments for why stocks actually made sense for a conservative investor. And his two main points were, first, that stocks could offer protection against inflation, which we just talked about.
Because they tend to go up in value over time, along with prices in general.
Right. And second, that historically, stocks have delivered higher average returns than bonds over the long run. And that's due to a combination of things. You've got the dividends that companies pay out to shareholders, and you've got the increase in the market value of the stock itself, which reflects the growth of the company's profits.
So you're getting both income and growth potential.
Exactly. But he was always quick to add that all of this goes out the window if you buy stocks at ridiculously high prices. Like, think about the bubble that led up to the 1929 crash. Those investors learned the hard way that overpaying for stocks can wipe out all those potential benefits.
And by the time the revised edition of The Intelligent Investor came out in the late 1960s, the market sentiment had totally flipped, hadn't it?
Yeah, it's amazing how quickly things changed. Stocks had gone up for so long that a lot of people started believing they were inherently safe investments.
They had this aura of invincibility.
Right. Even though Graham was looking at those valuations and thinking, this is getting crazy, these prices are way too high. He pointed out that by the late 1950s and into the 1970s, the dividend yields on stocks had actually fallen below what you could get on good quality bonds. So one of the traditional advantages of owning stocks, that steady stream of dividend income, it wasn't as appealing anymore. And by late 1971, there was a sense of cautious optimism in the market. The Dow was around 900, not super high, but Graham was still advising defensive investors to keep a good chunk of their money in stocks. He saw it as the lesser of two evils, compared to holding all bonds in a world where inflation was still a concern.
Okay, so let's get specific. What were the rules that Graham laid out for choosing common stocks? What should defensive investors be looking for?
He gave us 4 key rules, like a checklist for picking good stocks. First, diversification. Don't put all your eggs in one basket, right?
Spread the risk.
Exactly. He suggested having a portfolio of somewhere between 10 and 30 different stocks. That way, if one company does poorly, it doesn't sink your whole portfolio.
You're not betting your whole future on one company.
Right. Second, he said to focus on large, prominent, and conservatively financed companies. These are the blue chips, the companies that have been around for a while, that have a strong track record of profitability, and that aren't drowning in debt.
Solid, well-established companies, not those risky startups.
Exactly. Third, he said these companies should have a long history of paying dividends. And specifically, he said uninterrupted dividend payments since at least 1950. Because that shows that they're consistently generating profits and sharing those profits with their shareholders.
It shows they're committed to rewarding their investors.
Right. And finally, he gave some specific price limitations. He said don't pay more than 25 times the average earnings of the company over the past 7 years, or 20 times the earnings of the most recent 12 months.
So he's given some guidelines on valuation. Don't overpay, even for a great company.
Exactly. And those limits effectively ruled out most of those high-flying growth stocks that were all the rage back then. You know, those companies that were growing really fast, but that were also priced really high.
Why was he so cautious about growth stocks, especially for defensive investors?
He saw growth stocks as being inherently more speculative, riskier. They're all about future potential, future growth. And that future is uncertain.
You're paying a premium for that potential, but it might not materialize.
Right. And he pointed out that even some of the most successful growth companies like IBM and Texas Instruments, they could still see their stock prices drop suddenly and sharply.
Because things change, markets change, and those high expectations can come crashing down.
Exactly. So for a defensive investor, someone who prioritizes safety, that kind of volatility is just not worth it.
What about managing your portfolio once you've picked your stocks? How often should you be buying and selling?
Well, Graham recommended reviewing your portfolio periodically just to make sure that the companies you own are still meeting those criteria he laid out.
Make sure they're still solid investments.
Right. And he suggested that defensive investors could even talk to a financial advisor to get a second opinion. But he also said that, in general, if you've done your homework and you've chosen your stocks wisely, you shouldn't need to be trading very often.
It's more about finding those long-term winners and sticking with them.
Exactly. buy and hold, as they say. And he also talked about dollar cost averaging again, which is a great strategy for defensive investors, especially when you're first starting out.
Because it helps you build your portfolio gradually over time without trying to time the market perfectly.
Right. He mentioned some research that showed how profitable that strategy had been historically. And he noted that it was becoming more and more popular as a way to build wealth over the long term, especially when combined with things like savings bonds and life insurance.
So a nice balanced approach for those who are just starting their investing journey.
Exactly. And he even gave some examples of how these principles could be applied in different situations, depending on your personal circumstances and your financial goals.
So it's not a one-size-fits-all approach. It's about tailoring it to your individual needs.
Right. He talked about a widow who needed a steady stream of income and had to be very conservative with her investments. And he talked about a doctor who had a good amount of savings already and could afford to take on a bit more risk. And he talked about a young person just starting their career who he recommended should stick with a primarily defensive approach.
So different strokes for different folks.
Exactly. And he also made a really important point about risk, which is something that a lot of people misunderstand. He said that true investment risk isn't just about the price of a stock going up and down in the short term.
It's not about those daily fluctuations that you see on your brokerage app.
No. For Graham, the real risk is about permanently losing your capital, losing your money for good. And he argued that if you choose stocks carefully based on sound principles and you hold on to them for the long term, those short-term price swings don't really matter. As long as the company is doing well and its earnings are growing, you're probably going to be fine. And he also gave some more practical guidance on what he meant by those large, prominent, and conservatively financed corporations. He admitted that there's some subjectivity there, it's not an exact science, but he suggested looking at things like a company's assets and revenue, their position in their industry, and how much of their capital structure is made up of common stock.
So looking at the overall financial health of the company, not just the stock price.
Right. And he even threw out a rough number, like $50 million in assets or revenue, as a starting point for considering a company large, but he emphasized that this was just a general guideline, not a hard and fast rule.
Okay, so let's jump into Chapter 8, which is all about the investor and market fluctuations.
Yeah.
This is where things get really psychological, don't they?
They do, because this is where we confront our own emotions as investors. Graham starts by making a really simple observation. If you hold short-term high-grade bonds or U.S. savings bonds, you're pretty much immune to those daily price swings in the market.
You can sleep at night.
You can, yeah.
Yeah.
But if you own longer-term bonds, or especially common stocks, you're going to feel those ups and downs a lot more. And that can be really stressful.
It's human nature to want to buy low and sell high, to try to profit from those fluctuations. But Graham warns against letting that desire turn into like a full-blown gambling addiction, doesn't he?
He does. He says that if you choose to speculate, fine, but do it consciously with a clear plan and with limits. Don't mix it up with your core long-term investments. Keep those separate.
So have your fun money over here and your serious money over there.
Exactly. And he then lays out two main approaches to potentially profiting from market fluctuations in those investment-grade common stocks.
So he's not saying it's impossible, just that you need to be smart about it.
Right. The first approach is timing the market, which is what everyone thinks about, right? Buying when the market's going up, selling when it's going down. But as we've already talked about, that's really hard to do consistently.
It's like trying to catch lightning in a bottle.
Yeah, exactly. The second approach is more about focusing on value. It's about identifying stocks that are undervalued relative to their true worth and buying those, and then selling them when the market realizes their true value and they become overvalued.
So it's more about being patient and disciplined and letting the market come to you rather than trying to outsmart it.
Exactly. And Graham points out that this second approach, this value-focused approach, is much more in line with the principles of the defensive investor, the person who prioritizes safety and minimizes risk. Now, the financial industry has always loved to talk about market forecasting, predicting where the market is going. What did Graham have to say about all that?
Because you always hear those talking heads on TV making predictions.
Oh, yeah. And Graham was super skeptical about all that. He said that, yeah, the industry loves to promote the idea that you can predict the market, but the average investor, they just don't have the tools or the expertise to do it successfully over the long term.
It's a lot harder than it looks.
It is. And he really dug into the limitations of trying to time the market. He said that for speculators, those folks who are in and out of the market all the time, they might be able to make some quick profits if they're